The United Kingdom owes more money than at any time in its peacetime history. A national debt of roughly $2.9 trillion now equals 95% of the country's total output, and it still climbs by around $17 billion every month. It means Britain owes almost $41,000 for every man, woman and child. For 2 centuries, British government bonds, known as gilts, were among the safest assets on earth. Pension funds, banks, even foreign governments stored their wealth in them because Britain had never once defaulted. That reputation made borrowing cheap. It built railways, hospitals and the welfare state. But in 2025, that confidence is trembling. Interest rates are higher than at any point since 2008. Debt interest payments alone now consume $111 billion a year, more than the defense budget and nearly as much as education. And investors have begun to ask a question once thought unthinkable. Can Britain still afford its own promises? For more than a decade after the global financial crash, borrowing looked harmless. The Bank of England cut rates to nearly zero, and the government could issue debt almost for free. Politicians of every party learned the same reflex. When trouble struck, borrow. Then inflation returned. Consumer prices surged more than 11% in 2022, the highest in 40 years. The Bank of England pushed its base rate above 5%, and the cost of refinancing old loans tripled. The shift was brutal. In 2020, Britain paid about $40 billion a year in interest. By 2025, it is paying almost 3 times that. Money that might have gone to the NHS, schools, or public housing now flows straight to creditors. Keynes once warned, "The boom, not the slump, is the right time for austerity." Britain did the reverse, spending freely in the slump, tightening during recovery, and then discovering that cheap credit never lasts forever. Behind every statistic sits a household, a teacher in Leeds watching rent absorb half her pay, a small manufacturer in Sheffield whose loan costs have doubled, a retired couple whose savings earn more interest, yet buy less each year. The numbers are national, but the pain is personal. For centuries, debt was not a curse for Britain, it was a tool. After 1945, borrowing rebuilt cities and funded the National Health Service. By the 1970s, faith in that tool seemed unshakable. Then the system cracked. In 1973, the OPEC oil embargo quadrupled global prices. Britain, importing 95% of its oil, was hit harder than almost any nation. Inflation rocketed past 20%. Wages chased prices, and the pound collapsed. By 1976, gilt yields hit 15%, and foreign investors began to flee. Facing empty reserves, the Labour government of James Callaghan turned to the International Monetary Fund for what was then the largest loan in IMF history, $2.9 billion. It was a humiliation for a former empire. Callaghan told Parliament, "We used to think you could spend your way out of a recession. That option no longer exists." The IMF conditions forced spending cuts across the public sector and froze wages. It saved Britain's credit rating but scarred a generation. Hospitals postponed building, council budgets shrank, and the phrase "the winter of discontent" entered the national memory. Yet Britain never defaulted. The debt was paid, and with the discovery of North Sea oil later in the decade, confidence slowly returned. By the mid-1980s, petroleum revenue supplied up to 10% of all government income. The pound strengthened, inflation fell, and a new ideology took hold. The market would provide what the state no longer could. Through the 1980s and 1990s, Britain reinvented itself as a financial power. London's deregulated markets, the Big Bang of 1986, turned the city into the engine of national growth. Manufacturing's share of GDP fell from 25% in 1970 to 9% today, but tax revenue from finance disguised the imbalance. Economist Corelli Barnett warned, "You cannot pay high wages unless you have already achieved high productivity." The country celebrated high wages, but ignored productivity. For a while, globalization rewarded this model. Foreign capital flowed in, house prices climbed, and consumption replaced production as the driver of prosperity. Then, in 2008, the system that powered it all, credit, suddenly stopped. The global financial crisis began in New York but detonated in London. When Lehman Brothers collapsed, Britain's banks, heavily exposed to American debt, faced insolvency overnight. The government nationalized Northern Rock, bailed out RBS and Lloyds, and guaranteed deposits to stop panic. By the end of 2009, the rescue cost exceeded $137 billion, equal to 9% of GDP. Public debt jumped from 40 to 65% of GDP in just 2 years. Prime Minister Gordon Brown defended the move, saying, "We not only saved the banks, we saved the savings, the mortgages, and the jobs of the British people." He was right, but the recovery never fully came. From 2010 to 2019, GDP grew on average just 1.8% a year. Productivity flatlined, real wages stagnated, and the regional divide widened. Still, low interest rates masked the weakness. Borrowing cost almost nothing, and governments of every stripe continued to spend as though the golden age of credit would last forever. But credit booms always end the same way, not with explosion, but with exhaustion. By the time the world faced its next crisis, Britain's cushion of trust was already thin. Next comes the era of free money turned fragile, the pandemic borrowing spree, the inflation shock, the 2022 gilt panic, and the question no one thought they'd dare ask: what happens if investors stop believing in Britain? When the pandemic hit in 2020, the global economy froze overnight. Airports went silent, factories idled, and Britain faced the sharpest quarterly fall in GDP since records began, nearly 20%. To prevent collapse, the government opened the fiscal floodgates. Furlough schemes, business loans, and emergency support packages poured out at unprecedented speed. The Bank of England slashed its base rate to 0.1% and restarted quantitative easing, creating hundreds of billions of pounds to buy government bonds. In just 3 years, the national debt jumped by $620 billion, reaching $2.5 trillion by 2023. At first, few worried. Borrowing was practically free. Markets were grateful for stability. But as the world reopened, the flood of money began to distort everything. Prices, wages, housing, even the sense of what things were truly worth. Inflation, dormant for a generation, stirred again. When Russia invaded Ukraine in 2022, global energy prices exploded. Britain, a net importer, saw gas and electricity bills triple. Consumer inflation soared to 11.1%, a 40-year high. For households, it meant choosing between heating and food. For the Treasury, it meant paying far more interest on its short-term debt. Roughly 27% of all British borrowing now matures within a year, compared with just 6% in the early 1990s, which means higher rates bite almost instantly. The cost of servicing the debt leapt above $110 billion per year. The average 2-year mortgage rate jumped from 1.9% in 2021 to nearly 6% by 2024. Real disposable income fell more than 2% in 2024, the steepest drop since the 1950s. It was the kind of squeeze that doesn't make headlines every day, it just grinds people down. A nurse skipping meals on night shift, a cafe closing because its energy bill outstripped its rent. Economic pain, diffused across millions of lives. Then came the test that exposed how fragile trust had become. In September 2022, a new government unveiled what became known as the mini-budget, sweeping tax cuts with no matching savings. Markets panicked. Investors dumped British bonds. The pound plunged to a record 1.03. Within days, yields on long-term gilts spiked above 4.5%, a shock that nearly broke the pension system. Funds that had borrowed against government bonds suddenly faced margin calls as their collateral lost value. They were forced to sell even more gilts to raise cash, driving prices lower still. In less than a week, Britain's financial system teetered on collapse. The Bank of England intervened with an emergency purchase program, not to stimulate growth but to prevent implosion. It worked. The panic subsided. But the episode left a scar, proof that investor confidence could unravel in days after centuries of trust. And once faith wobbles, it never fully returns. Britain's crisis is not unique. It is part of a wider reckoning. Japan's debt stands near 250% of GDP, sustained only by its domestic savers. Italy hovers around 140%, its future tied to European central bank support. The United States at 125%, faces the same arithmetic but enjoys the privilege of printing the world's reserve currency. Britain sits uncomfortably between them, a major economy without a monetary empire, a borrower dependent on global faith. Economist Adam Smith once cautioned that a national debt, if it is not excessive, will be to us a national blessing. Excess, he warned, turns blessing into burden. Today, that burden is visible everywhere, a currency weakened by mistrust, investment flowing abroad, a generation priced out of ownership. Behind the bond yields and credit ratings lie quieter tragedies. Food bank use has doubled since 2019. More than 3 million households now rely on emergency parcels each year. The NHS waiting list stands at 7.8 million people. Real average pay, adjusted for inflation, remains 4% lower than before the pandemic. When public money feeds interest rather than improvement, social trust erodes. Citizens see taxes rise, services shrink, and wonder where the money goes. The answer, increasingly, is simply to the past, to interest on yesterday's promises. In that sense, debt is not only economic, but moral. It measures the gap between what a nation expected of itself and what it could actually sustain. The Office for Budget Responsibility warns that if nothing changes, UK public debt could exceed 270% of GDP within 4 decades, levels once seen only in wartime. What can be done? Cutting spending is arithmetically simple, but politically explosive. Health, pensions, and welfare make up more than half of public expenditure. Trimming them means touching lives. Raising taxes risks strangling growth. Britain already collects one of the highest tax shares in the OECD. The final option, printing money through quantitative easing, risks inflation and reputational ruin. For a country that built global finance on credibility, that would be self-destruction. Economist Paul Krugman once quipped, "Productivity isn't everything, but in the long run it's almost everything." Real rescue will come not from cutting or taxing, but from producing, making Britain more efficient, innovative, and export-driven again. History offers precedent. After the Napoleonic Wars, debt topped 250% of GDP. Through industrial growth and fiscal discipline, Victorian Britain paid it down over half a century. After 1945, debt again exceeded 200%, yet post-war rebuilding and productivity erased it within a generation. The pattern is clear. Growth heals what austerity alone cannot. But growth requires confidence, and confidence begins with competence. Britain's debt story is not one of failure, but of forgetting. The nation that once financed the Industrial Revolution and built a global credit system now struggles to finance itself. Its challenge is not numbers on a spreadsheet. It is faith, the belief that tomorrow can be more productive than today. If that belief returns, the figures will follow. If it fades, even the safest borrower can become the next cautionary tale, because history doesn't repeat, it reveals.